Good afternoon, this is Tiffany with the Cohen Group Northwest, and I'm thrilled to have a special guest in the studio with me today. His name is Luis.Gonzalez. He's a loan officer right here at Caliber Home Loans. You and I talk pretty often about the market, the Federal Reserve, interest rates, and inventory, and today we're going to go over some specific mortgage scenarios that we have right here in front of us.
Yes.
Thank you so much for joining me, and thank you for preparing some really interesting topics for us to discuss to kind of shed light on what the mortgage world looks like right now.
Yeah, absolutely. I'm so excited to go over these and just kind of help people figure out a little bit of where they could be, where they are today, and the steps you need to take in order to get the home that you want.
Now, I went through the pre-approval process recently myself. I still am in the pre-approval stage of the home buying process. And one of the biggest lessons, even for me as a professional in the real estate industry, is mortgages have a lot of moving parts.
Yes.
It's not just your income, an interest rate, and what money you're paying.
Yep.
You know,
but those are the things people think it
Right.
is. First things we look for are their credit scores, what types of assets and debts they have to play with. This allows us to kind of figure out exactly what realm, even based off of their monthly income. There's going to be a wide variation with those things in regard to what they'll qualify for in total. And then after we do that, we try to figure out, okay, if they're looking for a specific home in some sort of sale price range, or maybe, they need a 4-bedroom house and there's nothing in the cheaper side of things. What are the different scenarios or tweaks we can make in order to get them as close as possible to that?
Absolutely. And then too, you've got those differences between like a residential single family, condos with those association dues can definitely change your pre-approval totals. You've got like property taxes, there's the insurance, which is my backstory. All of those pieces all have to come into play for every single home loan structure.
Exactly. And those are all different little pieces that, again, not everyone thinks of right in the get-go. And so it's really important that we do all of this prior to wanting to put an offer on a home, because we tend to get a lot of people who find the house that they love and they absolutely want. And we can do a very quick turnaround on pre-approvals. But if there's anything that we need to tweak, if that takes even a month, that's going to keep you from getting that exact home that you were looking for. And so by doing a preparation, sort of like we're doing today, going through scenarios, we can build out these scenarios to bring them closer to that exact home.
So it's not a waste of time. This is a leading question, but it's not a waste of time then for someone who's like, I think I might buy at the turn of the year to give you a call.
No, not a waste of time at all. Please give me a call. The sooner we can get you all prepared, even if you don't think you're going to buy for the next 6 months, it's always good to have a foundation of knowing what you need now to do to be ready in 6 months, to get back into that price range, be where you want to be, and find that home.
Awesome. So we've got 3 different mortgage scenarios here, and we're not going to show all of these crazy numbers. And this is honestly, looking at this is why you work with a professional. This isn't bankrate.com where you spit in some numbers and get an idea. Zestimates, bank rates, none of that business.
No.
This is from a professional. This is real. This is detailed. These are scenarios. So on the screen, you'll see some key hit points, but just know that those are not a complete picture of any particular person's situation. Everyone's situation is different, all the things. But we're going to go over some specs here, and these are based on a income that is 125% of the median income for Bellingham right now. Now, as we all know, we've seen housing prices increase dramatically over the last 2 years, and we have not seen wage increases to match that. That is one of the rock and a hard place realities of our current economy right here in Bellingham. And unfortunately, the weekly market update, Caliber Home Loans, and the Cohen Group Northwest cannot solve those problems. But what we can do is talk about the realities of some of these scenarios, and then a professional like Luis or like one of the brokers on our teams can help you find a specific fit for your specific situation within the market as it stands today. So that kind of cleared out of the way.
Yes.
What's our first situation that we're taking a look at?
Awesome. So with that 125% median income, that's really the first thing we always look at is what is your monthly income, because that's going to give us the foundation for the rest. Obviously, credit score, all the other things we just talked about, but we always start with your income. And with that, 125% of median income in the Bellingham area is about $100,000, just a little bit under. And so this is for a household income typically. So 2 people, 3 people, however many you might want on your loan is perfectly fine. You can go quite high with how many people. Do you want to live with all those people? That's another question.
Or a family member kind of chipping in to help you qualify.
Absolutely. And so the reason I used this median income is because it brings us pretty close into the realm of where we see some home prices in Bellingham right now. And I thought it gave us great numbers to work off of that are pretty simple to give everybody just an easy idea, some key pointers to look at as you're going into the pre-approval process. Awesome. And so in this first section, it's just 125% median income. These people have no debt. Credit score I used across the board 740. So this is the best credit score for the best rates that you would get during the loan process. So if you're ever really close, we always try to encourage, let's work through a little bit of not even really credit repair at this point, but just tiny tweaks and improvements to get you ready over the next. Exactly. Summertime's coming. We're getting real close, so we all want that beach bod and awesome credit score. Let's go. Yeah. We came out at about a loan approval of first sales price of $550,000 across the board. I used 5% down. That 5% is the lowest. If you're a first-time home buyer, we can go as low as 3%, and then it goes all the way up. We've all heard 20%. But for today, 5%.
Awesome.
You're going to get a base loan amount of $522,500. And that's taken into account that 5% down payment of $27,500. With that being said, again, they have no debt. They have great credit. And so these are all factors of somebody who's going to be pretty much at the top when it comes to, there's not a lot of other improvements you can make on your end, besides if you wanted to bring more cash down to bring your monthly payment down, and then increase that sales price from there. It's a good foundation to look at, and then we'll move towards a scenario with a little bit of debt, and then a scenario where we are crunched on a certain amount of cash to close, and we want to stay within that realm.
So let's see the difference that having some debt on the books looks like. 'Cause most of us are going to have, a lot of us are going to have some sort of car payment potentially. Student loans are obviously a very hot topic in the financial world, the personal finance world. Some of us might have credit card debt or other types of medical debt, that sort of thing. So what scenario did we have for someone who's carrying in some consumer debt?
Sweet. So I went with the same median income, but we have $500 of debt monthly. So these are obligations again, car payments, student loans. We'll talk specifically about student loans because there's a little bit of a difference in that when we monitor debt. That can be to the benefit of people based off of Fannie Mae and Freddie Mac guidelines. And with that, we typically say, just as a general rule, that for every $50 of monthly debts you owe, you're going to see a decrease of about $10,000 in your approval status. And we'll see that exactly right here. So this person, same income, $500 of debt, same credit score, their sales price came out at $450,000.
Oh my goodness.
So that's about $100,000 off. And if we look at that, that's 50 times 10.
Wow.
And so $450,000 brings us right about the same debt to income ratio. When we're looking at debt to income ratio, we want to stay about 45%. With compensating factors, it can go up a little bit higher, but as a general rule, we try to stay at 45% debt to income ratio. With that said, this isn't the end all be all. This is why we start early. So if we see this and we want to get closer to, like, let's say 475, 500,000, we want to shave off something, we can look at either one, you paying off debt prior to closing, either on your own or through a loan. So you can add some of your other debts into your loan if we still have space in our debt to income ratio.
Gotcha.
So if we have a car payment, let's say $10,000 left on your car payment, and maybe it's $500 a month, then what we would do is we would put that into the loan at increasing $10,000 to your total loan amount above the sales purchase price. And then we'll see if that $500 being offset is actually giving you more of an approval, because it really depends on two different parts of this debt. How much is it taking off? So if it's $10,000, it's kind of the ratio. And then if it's the full $500 a month, then we have really good return on that. If it's only $100 a month payment, but you have 10,000, then we're going to see a little bit less of a reasonable offering to try to put that into the loan itself, because it most likely won't really give you that extra benefit and sometimes can actually go downwards. Just based off of, okay, we're not really solving how much extra monthly income we have in order to bring that towards our total monthly payment each month on our loan.
What I love about that is that you as a mortgage professional are able to offer multiple different pathways with the same end goal in mind.
Yes.
Here's what we can do on credit. Here's what we can do on debt to income. Here's what we can do on your loans and your current stuff. And you're able to offer a lot of if-then scenarios without you as the consumer having to make the choice right up front. Oh, I have to go figure this out on my own and then come back to my loan officer. It's like they can guide you through, is it worth the work that it would take to pay down your car loan by X amount? Is it worth it to wrap it into your home mortgage? I think that that's one of the key services that your side of the industry offers that's sometimes a little bit unseen, and it's so valuable.
Yeah, and I think the reason it's unseen is it really depends on again, I work at Caliber Home Loans in Bellingham, so I may be a little bit biased, but to have a professional that's local, that's going to communicate with you 100%, going through these scenarios with you pro bono, so that way we can prepare you rather than, maybe, again, bankrate.com. You're not going to get that same support in trying to solve your specific scenario. We're always looking at specifics. If there's anything we can do, especially when it comes to just a home you absolutely love, but we're just not quite there, we're going to try everything to figure out how to get you there the best way possible. And so by going through this debt scenario, you'll see a ton of these little guys as we go through them one by one, different adjustments at each time to try to see if you're comfortable.
Awesome. So that shows us the difference that having a certain amount of debt can make. I mean, that was a $100,000 difference on your final pre-approval cost. And in this market, you need all the pre-approval numbers, all the buying power that you can get. So on our third situation.
So this person did a really good job of saving up. And so it's the same median income of about $100,000, no debt, except this time, this person only has as much as the down payment. And the down payment on this, again, is $27,500. And so what else do we have as charges when it comes to closing on a loan?
Wait, I thought it was just a down payment. That's all I have to save up for.
And that's what we focus on first, right? And you absolutely should focus on down payment first. And everything else, again, we'll go through the details and try to find a scenario to make it work. Say these people really found a house that's $550,000. They'll win it if they give that purchase price. But they just don't have the money for the cash to close. What other scenario can we kind of go through? What we can do typically, and this is kind of going out of the realm of this specifically, because again, we're running up to that debt to income, but let's just say we still have a little bit of space to work with. What we could end up doing to try to cover that cash to close, closing costs and prepaid items is increase your loan amount once again. By the difference of what the total of your prepaid and closing costs coming together, asking this is where you bring in the realtors,
Yep.
is asking the realtors and the sellers of the home for a seller's concession. And we haven't seen seller's concession in probably 2, maybe 3 years at this point, really, because again, it was a seller's market, lots of buyers. So there wasn't really any incentive for any sellers to really give concessions to people. But it's a great way if you're strapped for cash, you only have the down payment amount to cover those closing costs with those seller concessions in order to bring you just as much as the down payment. You'll always have to bring the down payment, so we can't go below.
So the idea being, just to make up numbers here for a second, if the seller's willing to accept a price of $550, but you're able to finance a cost of $560, for example, you can then ask the seller, like, hey, can I offer $560, but you'll get $550, and I'm going to use that additional financed $10,000 towards my closing costs as a buyer.
Exactly.
That's the general concept.
Exactly.
Awesome.
And again, it's going to increase your monthly payment just a little bit, because again, your base loan amount is going to be a little bit higher. But we have been seeing these kind of slowly creeping back into the market. I just got a deal where we used seller concessions because they didn't want to bring that much money to the table. And they were actually able to get about $15,000 in seller's concessions, which was like, wow. Right now, I did not think that was going to happen.
We're moving that direction, and it's wonderful.
Exactly. Things are leveling out a little bit.
Right.
And the reason for this is there's not as much demand on some of these houses anymore, because prices have risen so high. Interest rates have gone up. And so you see the demand coming down. We're moving into summer. Summer tends to have more supply. So not to get into too much economics, but as that graph
I knew we would get there at some point
equalizes, exactly, we'll see that this tends to be a pretty simple option most of the time, both parties, if explained well. So again, have a good loan officer and real estate agent that knows how to explain this to a seller. Typically the agent will know, but it has to be a pretty good communication with the seller to let them know they're getting the exact same amount for their home. It's just when they hear, oh, I have to give you money in order for you to have the deal, they don't quite understand all the time. And so it really does bring a lot more cohesiveness. We all have to be on the same page of what this is for. The other benefit to using seller's concessions is, say we got that $10,000 seller's concessions to cover closing costs, but let's say that closing costs only came out to about $8,000 and we still have $2,000. What happens with that $2,000?
What does happen?
We can't go under our down payment, right? So we can't bring that in for down payment, but what we can do is use up that little extra money and bring it to lower the interest rate. So if you've ever heard of points being paid, or have ever gotten a quote with points, those points are to bring down your interest rate just a little bit. It's a closing cost up front, and by bringing that up front, you can get maybe an eighth to a quarter off, depending on how much money you bring. I mean, we can drop it down as far as you want. If you want to bring $30,000 extra to get a 3% interest rate, people would be happy to do it.
Absolutely.
And so we don't want to give up that basically free money on your end as the buyer, because that would go back to the seller. But once it's in contract, we have the opportunity to use it all. And so we'll always, if we start to run to where we've paid off all the prepaid items, we've paid off all the closing costs, let's move into interest rate. Let's skim as much as we can off of that, get that lower interest rate, which kind of offsets some of that monthly payment that you'll be getting with that higher loan amount.
And what's neat about that is, obviously there's a lot of moving parts here, and there's certain things that don't have wiggle room, just given the market prices of the house you love, that sort of thing. But just that reference there of a particular client being more cautious about what their monthly payment looks like versus another client going all in, I don't care, I make enough income that paying half of it every month in a mortgage payment. It's not the
Right.
end of the world when I get my dream house. Those types of,
Mhm.
every client has slightly different
Yeah.
priorities. And so you as a loan officer are able to talk them through what they want their financial
Yep.
picture to look like the next 2 years, 3 years, 5 years, when a refinance might be appropriate to either take advantage of lower interest rates if and when those do show up,
Yep.
or to just set up what their monthly payment is now and help them understand what it'll look like in the future. Like, at least you're locking in a payment for X number of years.
Exactly.
It's static. It's not changing. Here's what housing appreciation is likely to do. Obviously, coming back to your real estate broker for that. Your housing appreciation historically for the last 2 years, 5 years in that neighborhood, and then really hone in what is most important to this client.
Yes.
And then can we move forward on this house given all of those priorities?
And this is, again, just a conversation we have to have.
Yeah.
And the more of these things and scenarios that we have, the longer, in a sense, we have to prepare.
Right.
Because it's not up to me or your real estate agent to decide what's best for you. You have to be comfortable with that.
So we have these hypothetical purchase prices between about $450,000 to $550,000. And if you've been watching the market or watching my series, as you should be, you know that median prices in Bellingham and Whatcom County are now in the mid to upper sixes and into the low to mid sevens. So I wanted to show an example of the types of houses that have sold in the last 6 months or so. Obviously, the market is changing drastically, but an overview of what types of homes might be available in those price brackets. So I'm going to screen share from the be all and end all of real estate sources, which is the Northwest MLS. So here we have a map of all of the homes that have sold or active or are pending, single family residential in Whatcom County, priced between $400,000 and $450,000. This is the price bracket that that person who is holding a certain amount of debt would ideally be looking in. You don't want to be looking right up to your pre-approval. In that $50,000 range is a great just a great way to get some perspective on the types of houses that you would be looking at. Here we can see closed sales over the last 6 months are in red. Yellow are the ones that are currently under contract, and then a very few green ones are the ones that are active in that price bracket. We can see that they're stretched all across Whatcom County, a smattering here, a smattering there. For someone who is specifically interested in looking in Bellingham, we are seeing 36 houses now on this screen. So Bellingham, Sudden Valley, we've got a little bit over out here as well. There's 143 houses that sold in that criteria in the last 6 months in our county. So not a huge pool, but also not completely tiny or non-existent. For Bellingham itself, there's 19 options. Again, not a lot to look at, but what it means then is if you're in that price bracket and a house comes on the market, you jump. And another one comes on the market, you jump. And it's the throw spaghetti at the wall and see what sticks sometimes. If you can live with that house and live in that house and need to live in a house, that might be the strategy that one might need to take. Here's a list of what those houses look like as far as their sale prices. Days on market ranged quite a bit. You can see that some houses stayed on the market for nearly a couple of months, or in these cases, more than 3 months before they finally sold. And we can see an overview. A lot of them were 2-bedroom homes. Some of them were 3, some of them were 4. And in general, they were on the smaller side, with most of them being under 1,000 square feet. So when we look at the realities of the situation of what has been available and sold in that price bracket, you as a buyer would either need to go, this criteria is okay, or we have to broaden our geographical search to an area that's less expensive than Bellingham core. So that's a quick example on the 400 to 450 range. Now, say someone is pre-approved up to 550. So now we're looking at 500 to 550 and seeing what we have there. For Whatcom County, there were 206 matches in that price range. Again, this is single family residential because condos add a whole other level of complexity. We also see that it is also spread out across the county. And then zooming into Bellingham, let's take a look and see how many were in the general Bellingham vicinity, Bellingham and Sudden Valley. And there were 62 options in the last 6 months. Zooming into just Bellingham here, we've got 48 options. There's actually a fair amount listed, like active, which I'm thrilled about. Just goes to show how inventory is increasing, which we love. Here we have our days on market. also ranging from 0, something got listed today. A lot of homes were listed in the last week, and then on up from there. Here we can see bedroom counts, a lot of 2s, but a fair number of 3s all through here. And then if I go back and I look at square feet, again, a fair number in that under 1,500 square foot category, but it's not all small houses. We've got quite a few in the over 1,500 and up to 2,000, 2,100 square feet. So again, as a buyer, you and your real estate broker would be looking at the criteria given the constraints that your loan officer has given you as far as your buying power and going, awesome, here's what can be my realistic expectation of the type of house that might be a fit. For some of us, it means we look outwards first. If you want to live in Bellingham, you might be shopping in Ferndale or Blaine or Everson or Linden. It might mean that instead of getting a 4-bedroom house, you're getting a 3-bedroom house. It might mean instead of a 1980s build that's been updated, you end up with a 1920s build that was updated in the 80s, right? So all of these are moving pieces and moving parts with the eventual goal of finding not necessarily what is your dream home, but what is a solid fit.
Yep.
You know, and what we've seen as far as pricing appreciation and our current market, which I talk about literally every single week, it's a solid investment to get into a house. If it's a house that you can live in and see yourself being happy in for 2 years, 3 years, 4 years, even if it's not the eventual goal.
Yeah.
The equity gain that you're bound to see, which I'll go into in a future video, even though I don't have a crystal ball and none of us do, but the equity and appreciation gain that you're bound to see over the course of a certain number of years. And then not to mention that if interest rates go down, which they might not, but if they do, then there's an opportunity to do the favorite thing that you guys have been doing a lot of the last couple of years, refinance.
Refinance, yes. Love refinance.
You're like, wait, what are you saying is my favorite thing? Money is a very sensitive topic for most of us.
Absolutely.
And having our finances, our checking accounts, our debt, all of that just on display and talking about it with another human being can be a little nerve-wracking and a little scary. And I do think that might be one reason people sometimes like to call the 1-800 bankers as opposed to a face-to-face loan officer. And I happen to disagree with that. I recognize the sensitivity of that, and I have felt some of that sensitivity myself. But one thing that I appreciate about working with local lenders who are just good people, like you're good at your job and you're a good person who's interesting to talk to, neat to talk to, and like kind and compassionate, they are able to have those conversations every day with everybody. Like the fact that it's an x-ray of your financial statement is not abnormal to someone in your position. You're seeing those all day long.
Exactly.
I forget who I scarred by comparing it to a gynecology appointment, but I'm just going to scar everyone with that one now. But it's the type of thing that can feel sensitive or vulnerable, but it doesn't have to be. And so when you're working with someone that you trust and that you respect and who's knowledgeable and competent, they need to know everything and want to know everything about your income type, your future income, if you're self-employed, all those types of scenarios to help you know what's the best option for you. Because at the end of the day, it's all about the client and their houses.
The process will always have anxiety attached to it. It's never going to be anxiety free. Yeah, absolutely. But again, we do this every single day. And so we know how to prepare conversations that lead into these tougher conversations. And we have solutions. There's always solutions or preparation. Maybe we're not there today, and that may sting a little bit for some people, but we want to be there when it comes to preparing you for the day. Because if you come to me finding the house that you love, and then we're trying to bring everything at once to get you pre-approved, what's more anxiety producing than that? We're all so good at procrastinating, right? I'm a terrible procrastinator when it comes down to my laundry. I'm just like, oh,
yep, me too.
It's 10 o'clock. I'm not even going to dry it on time. And so by having that little extra time, we can go through it, and we always want to prepare everything, at least on our team, before we go under contract.
Amen.
Yes.
Yes.
So real estate agents love it. Sellers love it. You'll love it too. I promise. We want to send you as many of these guys as possible, these total cost analysis, to get you up and ready and comfortable with each scenario. So that way, even if we call it the window shopping phase, it's our favorite phase.
Yep.
I'm sure you went through it a little bit too,
Mhm.
where you get a ton of these guys there's 40 some homes on the market right now, and say we look at 10 of them. You send those over, we set you up with one of these, we go through a couple of them together, as many as you need, and then over time you just start to see the similarities that are happening. You even become a little bit familiar with the market. You say like, oh, 1 week he sent me one with this interest rate, and now it's at this, and then now it's at this. Ask us the questions, why are these moving? And the more you get information out of people like me, people like Ian Mullen on my team who's been on this show before, the more you'll feel comfortable with what the market is, telling your friends what you're doing.
Absolutely. So to pull this all together, mortgages are a complex instrument of financing, but they're not unsolvable. Any situation can either be mitigated, prepared for, adjusted, and it's really a professional and competent lender who's your best first contact when you're thinking about buying a home and have no idea where you land in this whole process. So I always recommend, as always, using a local lender. Luis is a great person to call in that situation. As always, if you have questions on any specific aspect of the real estate transaction or would like to see a specific professional on this show in the future, don't hesitate to send me a DM, give me a call, or an email. I would love to reach out to some more of the amazing professionals that we work with here in our industry and have them on this show. And thank you, Luis, so much for taking a good chunk of your afternoon to come out to our studio.
Thank you, Tiffany.
And talk about all things mortgage.